We wrote a small 10,000 specific reinsurance stop-loss contract on them. Their scenario was that they were paying about $155,000 renewal in fully insured premium dollars. And the year we wrote it, their reinsurance or stop-loss premiums were about $50,000, and their maximum funding level, their maximum aggregate claim level was about 110. So their max case scenario, if you will, was about 160, and again they were paying about $150,000 in premium. So they decided to move forward with it. The first year of their plan, after all the dust settled, they had incurred just over $7,000 in claims.
Wow!
So basically, they saved the better part of $100,000 the first year.
Right.
2 years now, and this was very unusual low claim activity.
Sure.
Understand, and what we surmised after the fact that being urologists in effect, they were able to treat or self-refer a number of minor type of conditions and just treat those in-house, if you will.
Right.
And the largest part of their activity, claim activity, was simply prescriptions.
Uh-huh.
That same experience carried over the second year. After about 2.5 years, they were sitting with a net surplus of nearly $250,000 in their claim reserve account.
My gosh, time to go to. They were already in Florida. Maybe they probably spent their money in the Rockies or something.
They were very pleased. So,
yeah.
And I use that as an example when I'm explaining self-funded, and because there's still the common objective, like, oh, well, unless you're 100 lives or 150,
right,
you really shouldn't be looking at this. And you cannot set the bar, on a number. Conversely, there are some very large groups of 100 or 200 plus based on their ongoing nature of conditions and history of shock claims and so forth.
Right.
That would not perform. That would necessarily not perform very well in a self-funded platform.
Right. So now let's get to why it's so interesting when you think about companies that are smart enough to self-insure and this new opportunity for medical travel and corporate medical travel. What's that like when you combine those two opportunities? Is the way you see it?
Right. It's a huge. It is a huge potential dynamic, Peter, from a couple of standpoints. Certainly from a financial standpoint. Again, as I mentioned, some of these larger groups, particularly once they've been in a self-funded framework for a number of years, they gravitate to higher and higher specific retention levels, which is the amount that they fund on a per claim basis.
Right.
So you can imagine that while they're funding these $50, $100, $200,000 claims, and that's regardless really of which network they're participating in. Mm-hmm. That's a post network discount amount that we can offer to them through medical tourism, a number of exceptional international venues that will transform that $100,000 or $200,000 claim down to a small percentage of that. Typically, what we've seen are 60 to 70% savings, mm-hmm. And these are across the board, regardless of really procedure or ICD code.
So let's take an example. Say it was a urology group. Say it's twice the size of your guys. So it's a group of 20 doctors or so, right?
Or 40.
Or 40. Let's say 40.
Okay.
So now an example is someone needs to get a hip replaced.
Mm-hmm.
That's a pretty easy one to talk about, right?
Certainly.
Typical hip replacement is how much?
In the States, 50 to 60,000, perhaps.
Right.
Yeah.
So and then if so in the self-insured model, that comes out of the money they've set aside for their healthcare for the year, right?
Well, right. They would have a let's say they had let's say it was a little larger group, and they had, for instance, a $50,000 specific level. Mm-hmm. Okay. In the States, you have that procedure. they're going to pretty much fund the entire bill, $50,000.
Right.
Okay. If electively the member would decide to travel to Costa Rica with a significant spouse or significant other, have their entire flight paid for, a great procedure performed, rehab on the beach, back in the States, for a fraction of that cost, maybe $12,000 to $14,000.
Right.
So the end result to the plan sponsors is savings of maybe $38,000 on one orthopedic procedure.
Right. And this becomes really compelling for larger companies, right? When you think about this, because you know, it's a big amount of money for a 40-person group,
right.
but if you really ramp up the actuarial tables for a 1,000-person company or more, the savings per year could be $250,000, right?
Or more. A simple way to deduce that is for the group to simply look at their experience,
right,
on their medical plan. Which groups at large typically have consultants or actuarial firms delving into that on a regular basis, quarterly reports, monthly reports, etc. And they can simply drill down into their claims data and look at the number, for instance, of procedures that they funded over 50,000.
Right.
And of those, then look into the ones that were elective in nature that could have realistically been outsourced to one of these foreign venues at a tremendous potential savings.
Right.
Orthopedics are certainly a very important facet of tourism, but again, there are significantly even higher cost procedures than that, involving cardiovascular procedures, oncology treatments, things of that nature,
right.
where you can be talking $250,000 claim being funded by a plan sponsor that could very well have as good or better outcome measurements performed, and again, in any number of international venues, for again a fraction of that cost.
Right.
30,000.
Yeah. So, and we only have about a minute to go, but this has been a great conversation, and I think it's been very enlightening to me, and I'm sure the audience will enjoy it too. If there's one of the things that I've been thinking about as we look at this space is, how do you motivate the employee to go, right? It's not just good enough to have this benefit in place. You got to figure out a way to motivate that employee to get out of their comfort zone a little and go down to Costa Rica for that hip replacement, or go to Korea for cancer care, or wherever it might be.
Exactly.
And the motivation is not only the spouse, but the corporation really needs a plan on sharing that savings, right?
Absolutely. The savings is important, but beyond that, is as you mentioned, Peter, you're going to have to establish a very strong comfort level on the part of the member seeking these services, and that's done via education. Educating them as to the excellent nature of healthcare in a number of these venues. The fact that the outcome measurements are comparable, if not superior, to those in many facilities in the U.S. The fact that a number of these venues offer services that actually cannot be obtained in the U.S. Speaking of certain stem cell therapies,
right.
That are being offered in Bangkok, China, etc., Korea. So, beyond just the financial gains, which are an absolute given, there are a number of other reasons to consider. The fact that a number of foreign national corporations that participate with U.S.-based health plans are participating under those plans under typically very stringent type rules and regulations that in many instances do not allow for a number of the culturally accepted practices, such as complementary alternative medicine, things of these nature, that they can incorporate as a self-funded plan sponsor. So they have a lot more flexibility in a self-funded platform. They can incorporate culturally accepted medical practices that are
interesting,
that are otherwise excluded from your standard U.S.-based healthcare policies. And they can be financially rewarded for doing so.
Excellent. Well, I think that's a good place to stop, and I hope you'll agree to be interviewed again. We'll find some more topics to go over.
Certainly.
But you bring a lot to the party. You clearly know your business, and we appreciate your time. So for Health Globe, this is Peter Propp. Thanks a lot, Keith Johnson.
Thank you, Peter. Take care.
Take care.
All right. Bye now.